You will be learning all the secrets on how to trade a market maker model. That is exactly what we are going to cover in this video. Now, learning the secrets to a market maker model is not really difficult. In order for you to know how to trade a market maker model, you need to know where and when a market maker model forms in the first place. If you don't know that, then you don't know a market maker model. So before a market maker model, there is context. Now, first we are going to define the context. After that, we are going to define the market maker model itself and how we can actually capitalize on that context. So if we define context, first off, defining context is also pretty simple. I've broken it down into, again, as you know me, of course, I've broken it down into very simple steps right here. Context, the first thing that we need to understand for context is the draw on liquidity. Draw on liquidity nowadays is made super complex, over complex you could call it. And I'll show you exactly how I get to my draw on liquidity very accurately and how you can do that as well. Then the second one, inside that context, we have the first one, draw on liquidity, like we mentioned, and the second one is PD array. Also exactly what we will go over right there. That is all you need to know for your context. Your draw on liquidity, your PD array. That's it. Then the first thing, if we dive again into that context, and now we are going to talk about the draw on liquidity. Then the first thing I need you to understand is a lag. What do I mean with a lag? A price action lag is a lag that is formed between either a swing high towards a swing low or a swing low to a swing high. So in this case, if we look at the weekly right here, we have this swing high right there. That swing high was responsible for pushing price lower. And that is also the most recent swing high that we have right there. That from that swing high towards that swing low right there, that is a price action lag. Just a lag. That's it. That's all you need to know. But the thing you also need to know is that there are high probability lags and there are low probability lags. I will mention them here, but I need you to take notes, especially on this video. It's going to be filled with notes. Because to define a lag, we just define it from a swing high to a swing low or from a swing low to a swing high. So this is also a lag right there, from that swing low towards that swing high right there. But there are low probability lags and there are high probability lags. High probability and low probability, again, meaning it's the strong lag is the weak lag. A strong lag has a fair value gap in the lag itself. So we can see that this swing high right there is responsible for creating one fair value gap, two fair value gaps, and a third fair value gap right there. So that is already the first indication that it might be a high probability lag. And the second indication that it is a high probability lag is that it is in context of the time frame above it. So meaning above this high, above that swing high, there should be no monthly lag with a fair value gap directly above that swing high. Which if we zoom out to the monthly, no, there isn't. There is no fair value gap just above that lag, just above that swing high there is, but that is not relevant. And I'll also go over later on why. So that weekly right there is in context of our monthly. That is important to understand. So then we summed it up, right? Then we have high probability lags and we have low probability lags. High probability lags, again, high probability lags have a fair value gap in the lag itself and they are in context of the time frame above it. And then of course, low probability lag is just the opposite. Low probability lag, no fair value gap in the lag itself and not in context of the time frame above it. Either one or two. For high probability lag, they need to have both those points. For a low probability lag, it can either be one of two. So a low probability lag, if it doesn't have a fair value gap in the lag, it's already low probability. Then it doesn't need to be in context. If it's in context still, it's already low probability because it doesn't have a fair value gap in the lag. If it isn't in context, but it does have a fair value gap in the lag, it's also low probability. So that is important to understand. For high probability, you need both. You need that fair value gap in a lag and you need it to be in context of the time frame above it. That is a high probability lag. That is crucial because that is at the foundation of everything. And believe it or not, that is at the foundation of a market maker model. If you can understand that, that is extremely crucial. So if we again just remove these lines right there and we zoom out again to the monthly time frame, then on the monthly time frame, we are seeing that we have this lag higher right there. That monthly lag higher. Does it have a fair value gap in the lag higher? No. All right, is it in context? Well, monthly is always in context because the monthly is the highest I would go. That's also what I would advise you. Don't go above the monthly. There's no need. So since there is no fair value gap in this lag higher right there on the monthly time frame, then that is already indicating that that is a low probability lag, meaning that when price moves lower like this right there, the first thing we can aim for right now is this low, because that is the first obvious discount array that is sitting right there. Because if we remember, for an order block to be high probability, it also needed a fair value gap. So without fair value gaps, price is nothing. As in, price is not high probability without fair value gaps. That is extremely crucial to understand as well, because that will tell you when not to trade and when to trade. And it will also tell you which direction to trade into. Because right here, we can trade into that discount array that is sitting right there in the form of that basic swing low. Then what can we also tell? Very simple. Where is current price action heading? Monthly, right there, the August candle is down. September candle is down. October candle is down. What is it potentially creating? A monthly fair value gap after this month's close. So after October's close, it can create a fair value gap right there on the monthly. That is important to note down. You should have that in your journal right there, that we are potentially, that we are in the third phase right there of creating a fair value gap. That is very important to note down. But is there any premium array right now on the monthly that we can say, all right, we can have a sting into and then we continue lower towards that draw on liquidity? No, not yet, because there's no clear fair value gap. We haven't even created the fair value gap yet. When we haven't created a fair value gap yet, then there's also no reason that we can look for an order block yet. We just wait right there. We're still creating that monthly fair value gap. Now, what have we just done? We have just determined on the monthly time frame the draw on liquidity. The draw on liquidity is very simple. It's extremely simple because all I'm doing on the monthly for the draw on liquidity and all I'm basically doing on every time frame, but the way I combine the time frames, write that down. The way you combine the time frames is important because that is exactly what I'll show you with the lags as well. But all I'm doing right there on the time frames is where are the most recent lags heading? As in, where are the most recent fair value gaps being created? This high right there is potentially responsible for creating that fair value gap and it's pushing lower right there. So the draw on liquidity, the first question in your context is where are we heading to? That is your draw on liquidity question. Where are we heading to? Likely the first discount array, because price is always reaching for either a discount array or premium array. Those are just your basic PD arrays. You don't need your premium and discount, 0 to 5%, equilibrium. You don't need that. You just need the PD arrays. Then this right there is the first discount array right there. So price could be heading towards that low right there. Just simply based off of the fact, again, of what we already talked about. The fair value gaps telling us a story right there. Then the second one in the context was what? It was PD array. With PD array, what do I mean? The question you can ask yourself for PD array is if we are heading there. So if we are heading where? If we are heading towards that low, which is our draw on liquidity, then where can we go lower from? Or how can we head there? What do I mean by that? That is your PD array. Because you need to understand, price has two phases. There's two phases in price. Nothing more, that's all you need to know. You either have a retracement or an expansion. In order for you to get involved, you don't want to be trading the expansion. You want to get involved as close as possible into the retracement to ride the expansion. And I'll show you exactly what I mean with that as well. But write that down because that again is very crucial to understand. So since we don't have anything to work with just quite yet on a monthly time frame, but it is important to note, have an alarm on your phone, whatever. In 17 days, we might have a new fair value gap sitting right there. Why is that important? Because all the lags that are in this singular monthly candle right there on a weekly basis, daily basis, 4-hour basis, if price wants to come into that monthly fair value gap right there next month, then all the lags on the weekly, what we just mentioned, and below that will get disrespected, will be low probability because we have a monthly fair value gap hovering just above it. So why a lot of people get blindsided, why their 1 minute lag doesn't hold? Well, my friend, because there's a monthly fair value gap hovering just above your head right there. And then off of that, you have high probability price action again. That is important to understand. That is why I need you to mark out, at least have a reminder that that monthly fair value gap will likely form. Now, if we do go into the weekly time frame right now, because we are looking for a PD rate to look for lower prices off of. Then here we are on the weekly time frame, and what can we see? Well, the most recent lags, again, if we go over the draw on liquidity, the most recent lags have been bearish. Everything that is to the left right here is not relevant to me, and it should not be relevant to you as well. As in, everything that's to the left right here, that weekly fair value gap right there is not relevant. When I say it is not relevant, I mean that it is not relevant to take a trade off of. When you are looking to take a trade, you are always looking to take a trade off of the most recent lag on every single time frame. The lowest probability price action comes from taking trades that are not part of current order flow. Order flow is not something I have touched on in YouTube just yet, but we are getting very close to it. All this to the left is not part of your current order flow. The most recent lags, and again, that is different for every time frame. That is why it's crucial to have this top-down analysis, because then you get to your most recent lags, you know which lags you can trade, etc. That is extremely important. The most recent lag here is that high towards this low right there on a weekly time frame. You can see it's different than the most recent lag from the monthly time frame. But we can definitely say that on a monthly there was no reason to take a long. On the weekly there was no reason to take a long off of this weekly fair value gap. Why not? Because it's not part of our current lags. It's not the recent lag. It's a random fair value gap, a random PD ray from the left of our chart. You need to understand, order flow is always the most recent lags, but the most recent lag is dependent on the time frame you are watching. It's like the relativity theory of Albert Einstein. Well, this is our money-making team time frame relativity theory. Now, and I did mention that you don't take a trade off of this fair value gap. Why not? Because that is calling a bottom. That is trying to call a bottom in the market. That is extremely low probability. Believe me, I'm talking from experience. And those trades, unfortunately, are easier to spot most of the time. They're very easy to the eye to see happen. But they are extremely low probability because you're trying to call a bottom in the market. Retracements, the retracement phase that might happen off of that is very choppy. You will likely take more hits before you eventually get that winner. And trading, if we think about it, trading is all about finding the winner without taking too many hits. And with hits, I just mean losses. Yes, we can all catch a winner, but some people will brag about their winner on Twitter and will have taken 10 losses before. Some people will have taken 2 losses before. Some people will have taken 0 losses before. And the money making team is very good at avoiding losses before we take actual winners, which at the end of the day makes us profitable, which makes us money because we don't take losses, very few losses before we take an actual winner. That is, of course, at the foundation of trading itself, but it's oftentimes overlooked. So this fair value gap is not part of your current lag, not part of your current lags, so you don't want to take a trade off of that. But what you can use this weekly fair value gap for is, of course, a target. So let's say you took a trade somewhere around here in this candle right there. You want to target something, then you can use that weekly fair value gap. That is perfectly fine because that is a discount rate, but use it as a target, not something to trade off of. We talked about two phases, a retracement phase and an expansion phase. This whole phase right there, based on the weekly, talking about this phase right there, was expanding. It's an expansion phase. Why? Because we didn't have a move into a premium array to continue lower just yet, meaning that we didn't have a retracement just yet. A retracement is just a move back into a premium array or into a discount array if we are bullish to then continue the trend. And continuing the trend is your expansion phase. So the retracement phase right here is into a premium array and we want to ride the new expansion. And riding the new expansion is just continuing that lag structure that we are seeing on the weekly time frame right there. So if we remove some things on the chart, because I like to keep my charts very clean, having a very clear mind on the chart, that is very important. Then right there, we have the most recent lag on the weekly time frame. We have that monthly target that is sitting right there. And that most recent lag is doing what? The fair value gaps are pointing towards what drawn liquidity? Towards that drawn liquidity. Just simply, very simple actually. I think my 4-year-old cousin could do this. I could sit him in front of the chart and I could tell him, where is the market likely heading towards next? And through his mind, he would likely say, well, we've been going lower, so I think we'll go lower. Yes, perfect. Yes, perfect. You're correct. And that is, of course, it's a bit more advanced the way we do it, because we are using the fair value gaps right there to tell us a story. And the fair value gaps right here are pointing towards that low indeed right there. So that is, again, drawn liquidity ticked off. Then the second one is PD array. If we are heading there, then how are we heading there? In other words, if we are heading lower, where are we likely heading lower from? Well, we know that this recent lag from that high towards that low right there, that is our most recent lag. That is a high probability lag. Why? Because we have a minimum of one fair value gap in that lag, and it is in context of the time frames above it. So with that being said, if that is a high probability lag, so we can look at it a bit more advanced, where we can now split that lag into multiple parts. And what I mean by that is the flood and the lot concept. So the flood and the lot concept, the flood stands for first line of defense. Then the lot stands for last line of defense. In between that flood and that lot, you also have your overlapping part. That is the main thing that we are going to talk about. That is the most important part to understand. The flood, overlapping part, lot. We are going to call it flood, odd, lot. Odd standing for overlapping defense. So what is the flood? The flood is the first line of defense. So when you look at a lag lower, then the first line of defense is, you guessed it right, is the first premium array if you are looking at bearish prices. So if we are looking at a bearish lag, which we have in this case on the weekly time frame, then the first line of defense is the first premium array we encounter. It is usually a standalone premium array, meaning that it's usually a premium array that is not overlapping with something. Meaning that it's usually 9 out of 10 times it's a fair value gap. Then right there, that is your first line of defense, but not exactly that. Why not? Because we have a low to the left right there. That low is overlapping with what? That low is overlapping with that fair value gap sitting right there. So if we drag the fair value gap a little bit lower beneath that low, that area, this area right there, that fair value gap area beneath that low is our first line of defense. The standalone fair value gap part right there. Then the overlapping defense is where we have the fair value gap overlapping with another PD array, aka overlapping with an old low in this case. That can be a breaker, can be a mitigation block, can be an order block, or just an old low or an old high. Of course, if you're looking at lower prices, an old low. Don't use anything else. And I'm not going to name anything else, but you know what I'm talking about. And the reason I said it is more so because I want to warn you. Because that is very important to understand. Because I've also been there. And the reason why we don't use that, because let me give you an actual reason. I think that would help for your mindset as well. If you understand the why. If you use 100,000 PD arrays, then you have 100,000 boundaries, 100,000 reasons to take a trade. That is going to be absolutely detrimental for your mental equity and for your financial equity. If I was to use anything besides that simple fair value gap, simple swing low, breaker block, mitigation block, order block, then I would already have so many reasons to justify a trade ID right there, which would make it low probability. Because if there's a boundary for me to go into the lower time frame constantly, then I can look everywhere for a trade ID. I can look everywhere for an entry pattern. If I can look everywhere for an entry pattern, then there's no high probability or low probability, which means that it's all combined, which means that it's all low probability. That is extremely crucial to understand. So when you're overthrown with all these PD arrays, ignore it. Please ignore it. And the whole reasoning, and I don't want to rant too long about this, but the whole reasoning behind that, behind needing that extra PD array, behind needing that extra confirmation, is usually because you can't make the basics work. And it's usually a lack. It's a lack of, you could say knowledge, but it's a lack of mastering those basics. Every great person in the world that has achieved something great. Now, I don't want to say I'm great or anything because I'm not. I'm not calling myself great. But every great person that I do know, that I've studied, they always tell, master the basics. A master is someone that has mastered the basics. And even the basics for us is quite advanced because our basics are not someone else's basics. So again, just use those PD arrays. You don't need anything else, because if you use anything else, then this won't work. That is why it's extremely important to understand. If you have a mentor, listen to that mentor, because if you combine that knowledge with other mentors' knowledge, it's not going to work. And again, you don't need to choose me as your mentor. We'll still be friends, even if you don't choose me. Again, that little rant is very important for you to do realize. Now, if we go back into the chart, that is our first line of defense right there. Then we have the OD, the overlapping defense. That is the fair value gap that is overlapping with that swing low. So this whole fair value gap right there is also the first line of defense and also the overlapping defense. So the darker part is the first line of defense. Then the lighter part is the overlapping defense with that low, of course. So that is classified as 2. Again, that is classified as 2. That is what we touched on actually in the fair value gap video itself. Because we said price is going to either go lower from that first line of defense, or it's going to go lower off of the overlapping part. And that is again told by time. So if we do mark out the rest of this, then we also have this fair value gap. We also have this fair value gap right there with that order block that is also sitting right there. Then these premium arrays that you have right there, there, and there. Are they relevant? No. Why not? It's not your first line of defense. It's not your overlapping defense. And with overlapping defense in this case, yes, it is the first overlapping part. So it's that low with the fair value gap. That is your overlapping defense. For price to come into that and disrespect everything here, then again, these overlapping parts are not any different from these overlapping parts. There's no monthly fair value gap above us just yet. So there's no reason for us to come into that, to come into that, to come into that. Which means that when we disrespect everything here, that also indicates that we can target these things right there. Not to take a trade off of, but to target right there. And then eventually, the last line of defense is your swing high or your swing low of the leg. If you're looking at bullish prices, last line of defense will always be a swing low. If you're looking at bearish prices, like we are doing right now, then the leg, the last line of defense of that leg will always be a swing high right there. The reason it's the last line of defense is because that last line of defense is the last premium array that price can head lower from inside that leg. As in, it can sweep that high and then continue lower. But because we have determined high probability legs and low probability legs, High probability lags have a fair value gap in it, and they are in context. For price to sweep that high is extremely low probability. That will not happen unless we will continue higher. So when we disrespect the first line of defense, the overlapping defense, then the last line of defense is a target. It's a target to take a trade towards. And then after we can see how we react there as well. But if we are coming back all the way towards that high, then likely we are not sweeping it. We are continuing higher and continuing higher towards the next swing highs as well. But what you'll see in low probability lags, where we don't have a fair value gap in the lag, where we are not in context of the time frame above it, that is where we will have a lot of the times the last line of defense that will get swept and we continue lower or continue higher. But again, that is also what we will touch on. So this is important to understand. Now, the only thing we need to have marked up right here is we can take away that high as well. The only thing I have marked up right there is this fair value gap and that swing low right there. And then through time, I want to confirm that ID that we are potentially going lower. Now, what is this? Just this area, that overlapping defense, the first line of defense, that is a premium array. And this is crucial to understand because this is where and when your market maker model forms. So we have now determined the drawn liquidity, where are we heading to, and the PD ray. The PD ray, if we are heading lower, where are we likely heading lower from? That right there is likely where we are heading lower from. It's not random because I mentioned it in the weekly forecast as well. This is just the whole thought process that goes on inside my brain. So once you have this context right there, then there's actually no real need to go into the time frames below it anymore. We don't need to look at this fair value gap to see if there's a daily fair value gap inside of it because we already have weekly context. All we are going to do right now is we can look to potentially, if the context is there again, look to take a trade into the weekly fair value gap and look to take a trade off of the weekly fair value gap right there to target that low and then eventually that low. Why is that? This right there, that area that we're coming in, the overlapping defense, that is what? That is a premium array. A premium array will be responsible for moving towards a discount array. The same as in a discount array will be responsible for moving into a premium array. And when I always talk about that, I talk about the most recent lags. So again, that is talking about the most recent lags because I can already hear someone think that this discount array will be responsible for that premium array. So this discount array is perfectly fine to trade off of. No, don't do that. Don't do that. This random discount array to the left might seem very nice to take a trade off of, but that discount array will be responsible for you blowing your funded account. 100%. I've been there. I'm talking from experience. I'm talking exactly what happened to me in the past, etc. And what happens to most people that start trading. This move higher right there, that retracement phase is lower probability than just trying to catch the easy expansion phase right there. So when you wait for the retracement to happen, it happens into a premium array. Then the expansion will be towards a discount array because price moves from PD array to PD array, meaning that price does not move from premium array to premium array. It moves from premium array to discount array, from discount array to premium array. What is the first discount array that price will encounter right here? It's this swing low right there. So this right there is your premium array. That is your discount array. Then in between that price action from that high right there towards that low right there, that is your context. That is where, if again, you can combine the time frames correctly, which we will go over as well, that is where all your order blocks will hold. All your fair value gaps will hold. Every single PD array will hold. That is where your market maker model will form. And that is exactly where it is. So that is exactly what we are also going to look at. And that is our context done. And then it is important to understand that once this low gets taken, that you need new context, whether it be off of the weekly time frame, the monthly time frame, the daily time frame. The drawn liquidity is still the same, but you always need new context. Context meaning, again, that drawn liquidity, PD array, and then it is that third step, that PD array to PD array, the premium array to discount array. Because then that means once you have that and you're waiting for that premium array to get tagged into, to have a sting into, then you're waiting for that retracement phase to happen, and now you can ride the new expansion phase. Before we dive into actually capitalizing on it, a market maker model is nothing more than the name for the delivery between a PD array to a PD array. That can be to a premium array, to a discount array, or from a discount array to a premium array. But nowadays, everything needs to be over complex. Because if you can't convince, then confuse. When it's complex, then of course, it's easily sellable. So right now, I want to dive into the daily time frame as well. So here we are on the daily time frame, and I just want to quickly hide the weekly fair value gap with the weekly overlapping defense right there. So if we hide that and we just look at the daily lags, then the daily lags right there, we have that swing high, pushing price lower, fair value gaps right there, holding, pushing price lower again, creating this new lag with this new fair value gap lower right there. Then this lag, that most recent lag, so I'm talking about that swing high towards that swing low, that did not hold. Why does this fair value gap with the overlapping part not hold? Well, if you're looking at the daily time frame only, then you might say, oh, but we have a daily fair value gap that is sitting right there. Oh, yes, okay, so daily fair value gap right there. Okay, but what is the difference between this daily fair value gap and that daily fair value gap? There's no difference. I would even argue if you're just looking at the daily time frame, then this daily fair value gap is higher probability. But what is even higher probability? Well, what is happening on the time frame above you? Because the time frame above you will always be stronger than the time frame you are looking at. So this high right there, that lag failing, is not that crazy. We already saw it coming. And it's not liquidity. It's not inducement. It's just looking at the time frame above you and realizing that on the weekly time frame, there's just a simple weekly fair value gap with an overlapping defense right there. And the funny part is that that fair value gap low of the weekly fair value gap right there is the exact high of the daily lag lower. So this daily lag, it has a fair value gap in it. So it might be high probability. Is it in context of weekly? No. Why not? Because there's a weekly fair value gap hovering just above that daily lag. So it's not in context. So it is low probability to take a trade off of. And look at what we just did. We made it so simple. We didn't need to look at all this daily time frame right there. Daily fair value gap right there. We might sting into that. We might sweep this. All that was relevant for me was that weekly fair value gap right there. That weekly context. That's all that's relevant. By zooming out time frames, by going up time frames, you make yourself so much easier. It doesn't need to be complex. And there's a reason for it. When you make your trading that simple, you will never, ever again mess up in your psychology because you have enough brain points to focus on your psychology. So if we dive back into the daily, then we can see this doesn't need to be complex because we're zooming out on the weekly time frame. So that sweep right there is not relevant because we're just coming into a weekly fair value gap. That's it. No need to make it any fancier than it already is. If we dive into this price action a little bit deeper, then we can see that we have a daily fair value gap there as well, which we talked about during NFP and after NFP, that video that we made. Disrespecting that fair value gap. Why? We have a weekly fair value gap above it most likely. So we're most likely trading into that weekly fair value gap. Bullish daily fair value gap that is responsible for the disrespect of that daily fair value gap, which creates an ST. An ST is a sharp turn. And it's important to understand because before we dive into capitalizing on that market maker model, that is exactly what you need to understand first, an ST. That is the capitalizing part, of course. First, you need to understand the context. Then that right there, from that daily fair value gap towards that swing high, that is again your context. That is where you can look to take a trade off of at the right time. So after NFP had a sting into that, that is perfectly fine to take a trade off of. But let's now actually look at how to capitalize on it, how to look at the market maker model right there that is forming. Because we are moving from that premium array to this discount array that is sitting right there. And even if we don't follow through, then we have enough price action to work with right there to at least capitalize on the ID. To at least capitalize on the rejection that we are seeing right now. Now, what are the next steps again? Well, we can't just go into the lower time frame right there, into the 15 minute of a weekly fair value gap. No, you want to combine the time frames correctly. So with every video that I make, you always see when I have a certain PD array on my chart, there's a certain time frame that I go into. I'm not going into the 5 minute or the 15 minute time frame of a weekly PD array. That is nonsense. Because you need to understand, if you're using a weekly PD array, the lower the time frame you use for your entry pattern, the more confirmation you are going to need. So a 1 minute time frame entry pattern on a weekly PD array is going to need a lot of confirmations before it can actually trade lower. But the 1 hour PD array combined with a 1 minute entry pattern is way less. So very early on, if we have a weekly PD array, we look at the 1 hour or the 4 hour, and you look for 4 hour confirmation, which is just a singular fair value gap lower. And on the 1 hour, it will require a little bit more, maybe 2 fair value gaps lower, maybe 2 high probability lags lower. And inside that high probability lag lower on the 1 hour, you could maybe look at a 1 minute entry pattern again. And inside that 4 hour confirmation of that weekly fair value gap, you could look at the 5 minute. The beauty of it is we are not just taking swing trades, we are taking scalps, we are taking day trades, whatever it is, off of that weekly context. Once you have that weekly context, daily context, monthly context, whatever it is, you have so much context to work with. The higher the time frame, the better the context. Meaning, weekly context, weekly premium array to weekly discount array. In between, you can go crazy. You can scalp, you can do whatever you want, as long as you understand where to scalp, because you're always looking to trade in a market maker model. A market maker model is again defined by moving from PD array to PD array. So let's look at how to trade that market maker model right here. If we go into the 4 hour time frame, then the thing we need to understand is that we want to trade at the right time. The right time is what we mentioned as well, is right there. The moves of this week will happen and the most volatility of the market will come in after CPI. That's what we mentioned in the weekly forecast as well. And the reason behind that is, previous video, time and price. So once we saw this fair value gap being created, or even a higher fair value gap right there, but time, again, time was responsible for pushing into that fair value gap right there and continuing lower off of it because it showed an entry pattern right there. Then once we have this premium array, what is the next discount array? Right there. So that is what? Your context. That is what? Your market maker model, because that is where your market maker model will form. Now in itself, if you're a swing trader, this is already an entry. That right there is already an entry to continue lower, to target your 1 to 2 right there. That is already a long-term entry that you can do if you are into that, of course, if you are interested in that. Of course, not financial advice, but what most of us will do is in that 4 hour right there, we will go into the 5 minute, because on the 5 minute, we are seeing a sting into that fair value gap right there, into the 4 hour fair value gap. And the target is that low, which is the context low that we saw on the 4 hour. And eventually that weekly low. But first this context low, because after that context low is taken here on the 4 hour, remember what we talked about on the weekly, then we need new context again. So what are we doing right here? What do we want to see? We want to see the exact same thing as we saw on the higher time frame. We just want 5 minute context, but the 5 minute context won't be responsible now for us to look into the 30 seconds time frame to look for another entry. No, the 5 minute right here is responsible for us right now to take a trade off of with the same exact premise, what we just did, a drawn liquidity PD array. That is our context. And the first thing we need is an ST. And we could argue, again, that an ST is already happening right there. Now, if you're in a mentorship, then you know this is a consolidating ST. And it's also a fake top right there. It's not high probability. So once this gets taken right there, and let's say we took that. All right, we have a -1. Fair enough. Let's say we did take that. Then right there, that's a -1. Perfectly fine. So let's keep that in mind. We took a -1. All right, perfect. Let's look afterwards. What do we have? We have a small ST that is sitting right there in the form of that fair value gap. That fair value gap creates a lag. Then that lag pushes lower with a new lag right there. That lag lower creates what? Your first line of defense, your overlapping defense, which is right there, and your last line of defense. This is your first line of defense, that first fair value gap. So what is up to you? Up to you, my friend, is just choosing your entry pattern. As long as you understand that you need to combine the timeframes correctly. This is going to take some work on your side as well. Unless you're in the mentorship, you already know how to do that correctly. But if you just copy me right here, then you're going to be fine as well. So on the 5 minute, 2 high probability lags lower. And then you have the first line of defense, the overlapping defense. Last line of defense would not be, I would not advise to enter off of that. So you choose either the first line of defense or the overlapping defense. That is where your entry is always going to be. There's no in between. So if you are choosing an entry pattern, you choose first line of defense, overlapping defense, either one of those two, and you stick to it. It's not, oh, I might now choose overlapping defense. I'm now going to enter off the first line of defense. No. From my experience, that is not going to work because that is going to make you emotional. In that moment, you just need a guideline to tell you, I need to enter off the first line of defense. Perfect, let me place my entry there. In that moment, you're too emotional to think, oh, well, maybe I can do this, maybe I can do that. No. That's not going to work. It's not going to cut it. That is where picking your poison comes in. And what do I mean by that? There's pros and cons to both of those. There's pros to the overlapping part. The overlapping part, you might miss the trade sometimes. There's pros to the first line of defense. First line of defense, you might have a worse RR sometimes. Again, neither one of them is better than the other. It's about picking your poison and what is your preference right there. That's it. So let's say we entered off of the first line of defense. We cover the last line of defense. Hey, that makes it pretty easy, right? That makes the stop loss placement pretty easy. And why last line of defense right there? Well, of course, you need to take into account that is your high probability lag. Why is it high probability? Because it's in context of the 15-minute and 1 hour as well. So on the 15-minute, there's no fair value gap hovering above that lag. On the 1 hour, there's also no fair value gap hovering above that lag right there. In context of that weekly as well. Because we're having all those time frames in context right there. We targeted a 1 to 2, perfectly fine. We already made that loss back and we made an extra percentage. Okay, that's pretty nice. Now, after we are in this trade and we take that low that is sitting right there, which is the 4-hour context low, will we, because this lag might hold right there, can we take a trade off of that lag? Why didn't it hold? Why does that lag not hold? Everyone watching this video knows why. All those people clueless on why that lag doesn't hold. It should hold right there. It's the order block. It's high probability. Why doesn't it hold? Everyone watching this video, we already know you need new context. And that context is, again, zooming out on those time frames. And let me give you a quick little cheat. When the first context was on the 4-hour, what you would do is you drop one time frame below that to look for new context. Once the context low is taken out. It's the same for the weekly. When the context low is taken out, you drop down one time frame below that weekly time frame, which is of course the daily time frame, and you look for new context on that. Same for the 4-hour. Then you go into the 1-hour time frame to look for context on that. So if we remove these right there, that entry right there, and we look at the 1 hour, then the 1 hour right here is having those fair value gaps right there, which creates, what does that create? That creates your new context. Premium array to discount array right there. Inside that 1 hour fair value gap right there, can we go into the 5 minute again? Yes, we can, but we need a different entry confirmation. You can either use a 5 minute and just a 5 minute ST only, or you can go into the 1 minute to look for your 1 minute lags. If we dive into the 1 minute right there. So here we are on the 1 minute, and now you can see people that get blindsided right there by these trades. See how it's so simple. It's so simple to overcome that. It's so simple yet so complicated. You don't need to know that it's going to sweep all this on a 1 minute time frame and it's going to reach into that 1 minute order block that's sitting right there. No, it's nonsense. It's absolute nonsense. It's just to distract you. All you need to know right there is that we're coming into that 1 hour fair value gap and we can continue lower off of that. Because all these order flow lags below that 1 hour fair value gap are low probability. On the 5 minute, on the 15 minute, there are low probability lags below that 1 hour fair value gap. So here on the 1 minute, this is again where you can perfectly fine trade the 1 minute on Forex. Yes, you can. If you just know what you're doing. Then right there, we're seeing a 1 minute ST. That is not where you want to enter. You want to wait a little bit more. Unless it was a 5 minute ST, then it was perfectly fine. Then right there, that is your perfectly fine entry right there. Where do you place your stop loss? Let's look at the 5 minute as well. The 5 minute didn't create a fair value gap just yet. So if we go back into the 1 minute, then if we enter off of that, we can cover that high right there. Now, this is of course where also a little bit of a logic comes in. Covering that high, aiming for the absolute moon right there, or the bottom, you could call it, and going for 1 to 100 RR. No, just don't do it. If you cover that high, you have enough price action before we even come close to that 1 hour context low right there for a 1 to 2. Just cover that high. Don't suffocate your stop loss. Suffocating your stop loss, and again, I'm speaking from experience right here, suffocating your stop loss is it's such a shame because the hard work was done on the context, on the higher time frame, on finding where and when the market maker model will form. When the market maker model forms right there, all you need to do is choose your entry pattern. The entry pattern is stupidly simple. It's stupidly simple. The only thing that's difficult about an entry pattern is that you likely have emotions coming to rise. Oh, am I doing it right? Am I not doing it right? That is why you have those guidelines set for your entry pattern. That is why, technical wise, the entry pattern is the easiest thing in the world. So when you make your entry very difficult with a very tight stop loss, then you might just get a sting into your stop loss and it continues lower. Don't suffocate your stop loss. Reward yourself by finding the right market maker model, finding where it forms. That is extremely important. So again, this can be the first entry right there. Then after that, you can just follow along with the fair value gaps. That is exactly, again, where the market maker model gets very interesting because you just follow along with the fair value gaps right there. That is another entry. But you need to be aware of the fact that you are now also creating 5 minute and 15 minute fair value gaps and potentially even 1 hour fair value gaps lower. So eventually, when you see something like that right there, an entry like that, you think, oh, that's perfectly fine. That's a great trade right there. No, why not? At that moment in time, what has happened? Well, some time has passed. There is likely a 5 minute fair value gap or even a 15 minute fair value gap hovering above that 1 minute lag. So that 1 minute lag, is it high probability? No, not anymore. If you zoom out, then here we are on the 5 minute and we can see this fair value gap right there even. But if we zoom out to the 15 minute, then on the 15 minute, we even have that right there, that 15 minute fair value gap. So that is the fair value gap that you need to be aware of. That fair value gap creates what? New context. Because that fair value gap can just deliver towards new lows. And can eventually deliver, of course, towards that 1 hour context low as well. That is when in between the context of the 1 hour context, 1 hour premium rate to 1 hour discount rate, you need to be aware of the 5 minute fair value gaps, the 15 minute fair value gaps, because you're constantly scouting those fair value gaps. What is a high probability lag? Is this a high probability lag? No, because there's a fair value gap hovering above that lag right there. The same what we just saw from that 4 hour delivery, 4 hour fair value gap, 4 hour low right there. We remove everything that's here. This right there is where we are seeing a sting into that 15 minute fair value gap right there. We're seeing a sting into that 15 minutes, very small 15 minutes fair value gap right there. Those 15 minute fair value gaps right there is what you need to be aware of. Because on the 1 minute, you will likely have lags that won't hold and you will get blindsided by a sweep. And it's not really a sweep because it's just a move into the 15 minute fair value gap to continue lower. But off of those 15 minute fair value gaps, that is again where you have the 15 minute fair value gap, 15 minute premium rate, 15 minute discount rate that was sitting right there. That is perfectly fine to take a trade off of. On either you enter off the 50-minute directly, or you go into that 50-minute fair value gaps to look for an extra 1 minute entry. And that right there is constantly that context from the premium rate to the discount rate on every time frame. And you can see how fractal it is because it happens constantly in each other. As in, you have 4-hour context that we talked about right there, 4-hour premium to 4-hour discount. And you also have inside that 5-minute, 15-minute. It's all the same. And every time that context happens, that is where your market maker model forms. And that is all you need to know. And now, the beautiful thing we did right there, we incorporated a lot of concepts, but there was absolutely zero need for us to reference it. I just explained market maker models to you in such a way that you now understand all the ins and outs that you need to understand about a market maker model without needing to understand all the irrelevant things that go around it. This is the beauty. You now understand market maker models to such an extent better than 99% of the ICT traders, just because you know a few simple rules in a very mechanical step-by-step manner as well. And again, the most important part was knowing when and where the market maker model forms. And the market maker model forms, again, from that context, which was defined again, context, drawn liquidity, PD rate, and that PD rate to that PD rate. And that PD rate to that PD rate, premium rate to discount rate to premium rate, that is exactly where your market maker model forms. And that is where you can capitalize on it. And then I just showed you how you can capitalize on it as well. And it's constantly scouting for those timeframes, seeing what is happening. Do we have fair value gaps being created? That is very important. And once we move into that and we understand those lags, that's all you need. And again, the thing we used the most here was fair value gaps. It's all in the fair value gaps itself. So from that 4-hour premium rate to that 4-hour discount rate, that is exactly where your order blocks, your fair value gaps will all hold right there. Very simple delivery. And you can see it happens quick. Boom, boom. Price does not waste time in high probability price action right there. It's not wasting time. The retracement right there takes longer than the high probability price action itself. But of course, if you're looking at bearish prices, you want to trade a market maker sell model, as in you want to trade the sell side. So you just want to look at the prices lower. All this is not relevant. Moving higher right there is not relevant. That's a retracement phase. You don't need to get involved right there. You don't need to do anything with it. And see how long that takes right there. 12 hours, and the actual delivery takes what? 3 hours. High probability price action happens very fast. And the high probability price action is always when you have context. And you don't need to make it yourself difficult. You don't need to know that we are coming into that 15-minute order block right there with sweeping that swing high right there. No, because if you just combine the lags and you look at the most recent lags constantly, and the most recent lag here on the 15-minute, it's this swing high right there. But is that high probability? No, because it's not in context of your 1 hour, because the 1 hour most recent lag is just that lag right there. And this way you make yourself very simple, yet extremely effective. The money making team is, there's a reason it's called the money making team. And this exact thing is what I use constantly to identify where we have those market maker models. And then we just execute on them. So this is what you see me do inside the weekly forecast. This is why we were even able to go over GU right here. And you will always see that I pick out the price action that I actually called beforehand in the weekly forecast. Or I did it live. And the same with NASDAQ right here, where I was able to call it live. Where will the market maker model form? Where will this form, etc. I recorded it live again. But that this time is for the mentorship. I just want to show you that again, this is all applicable live, because that's the only thing I do. And it's the same exact premise, and that is what I want you to study. Go study NASDAQ right here and go study ES right there, because both ES and NASDAQ right there is exactly what happened. It's exactly the same thing that happened as well. It's absolutely beautiful. If we go over really quickly actually, then here on ES, what we saw, we were disrespecting that monthly fair value gap. All right, weekly, what are we doing? And this is my thought process. Very fast right here. Leg right there. Overlapping part. Fair value gap as well, sitting right there. In the daily time frame, we have those daily fair value gaps higher. Now again, the same thing as we saw on GU. We have daily fair value gaps higher. Daily fair value gaps higher are not relevant. Why not? Yes, it's part of the most recent leg. Which fair value gap is a stronger one? The weekly fair value gap is a stronger one. Why is that? Because the weekly fair value gap is on the time frame above the daily fair value gap. So that weekly fair value gap will be stronger than that daily fair value gap. You can use it as a first target, but don't use it as something to trade off of. Then on the 4 hour, you saw 4 hour move into that fair value gap. We eventually continued lower. And on the 1 hour as well, you saw this move right there into that fair value gap that is sitting right there. And you saw a move into that order block with that fair value gap. We swept this. The reason why? Time. Time was supporting the idea of sweeping that. Because once we go into that order block right there, you can look on the 1 minute because that creates again your market maker model. And then in the 15 minute right there, you have a new fair value gap right there as well. And eventually you also have this fair value gap that is sitting right there, which is just your most recent lag. And then we continue lower off of that as well. And that is where at those premium rates towards those discount rates is constantly where your market maker model forms. So just based off of that weekly fair value gap, that is where your market maker model forms. So when the market maker model forms on the weekly time frame, then in between that weekly premium rate to that weekly discount rate, you have a lot of price action to work with right there. So once this happens, the right time, this is a fake top, which you will learn about in the next video as well. That is exactly when you get your ST, etc., your high probability lags lower. That is when you have your bigger market maker model. And inside of that bigger market maker model, you have small market maker models. And that is extremely powerful. Extremely powerful. To study that, feel free to send me your studies as well. And I would love to have you alongside in the money making team as well. Feel free to take a look at that. Take a look at what other people are saying as well. So you don't have to take my word for it. And then I'll see you tomorrow at the free weekly forecast on Sunday. Perfect. Thank you.